To calculate money supply, we need to multiply the base by the multiplier. The base is the amount of money we started with. Money supply equals base times M. In our example, the base was $100 and the money multiplier is 10. Therefore, total money supply is $1,000. Since we started off with 100 and ended up with 1,000, that means the fractional reserve system created $900. Let's go over another example. How much money can banks create with $500 and a reserve ratio of 5%? The money multiplier equals 1 divided by the reserve ratio. M equals 1 divided by 0.05, which equals 20. For every $1 that is initially deposited into the bank, the fractional reserve system will create $20. Money supply equals base times the multiplier. 500 times 20 equals 10,000. So the banks created $9,500. Now that we know that banks can influence money supply, and it's the Fed's job to control the quantity of money in the economy, let's discuss the Fed's tools of monetary control. There are 3 tools the Fed has to influence the supply of money. The first is reserve requirements, which are the regulations on the minimum amount of reserves that banks must hold against deposits. The smaller the reserve requirement, the less money held in the vault, and the more money banks can lend out, therefore increasing the money supply. The larger the reserve requirement, more money is held in the vault, and the less money banks can lend out, therefore decreasing the money supply. This tool is rarely used because it causes large changes in money supply. To see for yourself how large the change in money supply is, calculate total money supply with a deposit of $1,000 with a reserve ratio of 10%, then with a reserve ratio of 5%. The second tool of the Fed is the discount rate. The discount rate is the interest rate on loans that the Fed makes to banks. Banks borrow from the Fed when they are short on meeting their reserve requirements. This could happen if the bank has too many withdrawals in one day. When the discount rate is high, banks are discouraged from borrowing from the Fed. Banks will keep more money in reserves, make less loans, and reduce the money supply. If the discount rate is low, banks keep less money in reserves, make more loans, and increase the money supply. The third tool of the Fed is open market operations, OMOs, which are the purchase and sale of government bonds. When the Fed conducts an open market operation purchase, they increase the money supply. When the Fed conducts an open market operation sale, they decrease the money supply. Open market operations is the tool used most often by the Fed because it is very precise. There are 2 problems controlling the money supply. The Fed's control over money supply is indirect. The Fed cannot dictate savings behavior. Sometimes people put money in shoeboxes or safes rather than depositing money into bank accounts. The Fed cannot dictate lending behavior. Sometimes banks hold excess reserves beyond what is required. Since the Fed cannot control either, they do not have direct control over the money supply.